In the first days after the long-awaited decision of the Federal Reserve to cut the key interest rate, the United States was gripped by euphoria. Markets surged, investors spoke of a new era of growth, and representatives of the Trump administration rushed to call it a victory over inflation. However, only a few days passed before the dust settled. Now that emotions have subsided, the cold calculations of analysts have surfaced, and the forecasts turned out to be much darker than the White House had hoped. According to Bloomberg Economics and the Financial Times, the rate cut was more of a forced move amid growing problems than a sign of confident control over the situation. Economists note that as markets adapt, worrying signals are becoming clearer on the horizon. Inflation is starting to reawaken. In some regions, prices are already rising for basic goods, from bread and milk to meat and fuel. The Wall Street Journal, citing data from Walmart and Kroger, reports that in recent weeks prices for essential categories of goods have been steadily climbing, and this trend appears persistent. Experts explain this not only by seasonal factors, but also by a combination of deeper causes: Donald Trump's trade war with China, global market uncertainty, overheating in certain sectors of the U.S. economy, record national debt exceeding $36 trillion, and declining trust in the dollar as the world's reserve currency. Special attention is being paid to a trend highlighted by Nikkei Asia and the Frankfurter Allgemeine Zeitung. More and more countries, including China, India, Saudi Arabia, and Turkey, are reducing their share of dollar assets and increasing their gold reserves. The World Gold Council records record purchases of gold by central banks, the clearest signal yet that the world is preparing for turbulence. Analysts at JP Morgan note that such moves are not random, but part of a strategic reconfiguration of the financial system. As one insider at a European bank, who requested anonymity, put it, "If the dollar once had no alternative, now many governments openly say that the risks linked to US debt and inflation are too great to keep all eggs in one basket." The question being raised across expert circles now is whether Donald Trump's administration will be able to cope with the looming crisis. On the one hand, the White House insists that the rate cut will stimulate business and keep the economy afloat. On the other hand, more and more analysts argue that inflationary pressure will only intensify, potentially hurting ordinary Americans by raising the cost of loans, food, and energy. The Economist bluntly writes, "America faces a new economic storm, and the reappearance of inflation in everyday life is only the beginning." Adding to this is the political factor. Trump's trade war, restrictions on Chinese imports, and Beijing's retaliatory sanctions are all hurting American exports. Farmers in the Midwest are already facing falling incomes, while major corporations complain of shrinking supplies of critical components. According to congressional sources, doubts are increasingly voiced in private. Is the strategy of economic pressure proving too costly? Inflation, rising food prices, a weakening dollar, the global shift into gold, and an overheated debt market. These are all elements of one equation pointing toward an impending crisis. This time, it is not about a local recession, but a systemic shock that could reshape the balance of the global economy. And now, the main question is how the world will weather this storm. In 2008, the crisis began in the United States and crashed global markets. Today, experts from Oxford Economics and the IMF warn that if America once again becomes the epicenter, the consequences will be far more severe. This time, trust in the dollar and in the American financial system is weaker than ever before. Markets are waiting for new steps from the Federal Reserve, investors are waiting for action from the White House, and allies are waiting for leadership from Trump. For now, more and more data suggests that what lies ahead is not relief but years of instability. The question is no longer whether a crisis will begin, but how deep it will strike and who will manage to survive it with minimal losses. In recent days, experts have focused on data from the U.S. Bureau of Labor Statistics. It shows in black and white that the Consumer Price Index in several regions has started to rise faster than expected. The food market is especially alarming. In New York, Chicago, and Los Angeles, prices for meat and dairy products have jumped by 4 to 6% in just a few weeks. In the southern states, fuel and transportation services are getting more expensive. Economists call this the first bell, when local price spikes evolve into a nationwide trend. The Wall Street Journal writes in a recent article that consumers feel the crisis in their wallets long before statistics officially register inflation. Public debt also deserves separate mention. The growth is becoming exponential, and analysts at Moody's are already warning that in the coming years, interest payments on the debt could exceed defense spending. This means the US will increasingly borrow new money just to pay off old loans. A classic debt trap, as a Financial Times expert commented. Equally troubling are gold statistics. Since the beginning of the year, the central banks of India and China have increased reserves by more than 300 tons. Saudi Arabia, Turkey, and even Poland are taking similar steps. Nikkei Asia writes that we are witnessing a process of de-dollarization, gradual but irreversible. The world is ceasing to believe in the dollar as a guarantee of stability, and this process is directly tied to US inflation. Every new dollar emission drives states to seek protection in metal that for centuries has symbolized value. Insiders at major investment banks privately admit that the market increasingly feels a sense of déjà vu, as if the scenario of the 1970s is repeating, when America went through stagflation against the backdrop of an oil shock and geopolitical instability. Then price growth coincided with a production slump, and the economy entered a prolonged crisis. Today, we see the same symptoms: slowing GDP growth, rising inflation, stock market volatility, and declining trust in the dollar, one top manager at Bank of America told Reuters. Many analysts emphasize that the fault lies not only in economics but also in politics. Trump's trade war with China fueled inflation by making imports more expensive. In response, the Chinese cut purchases of American agricultural products, hitting the US farming sector. This has already led to rising unemployment in some regions, CNBC and Bloomberg report. Within the Federal Reserve, according to Politico, disagreements are growing. Part of the leadership believes that cutting the rate was a mistake because it only accelerated inflation. Another part argues that without this step, the economy would have collapsed much faster. In the corridors of Congress, lawmakers are already discussing the possibility of pressuring the Fed into more aggressive action. But one thing is clear: room for maneuver is shrinking by the day. International experts warn that the world is not ready for a repeat of a crisis on the scale of 2008. Back then, the global system saved itself thanks to trust in the dollar and in American bonds. Today, that trust is gone. The IMF states in its latest report that any large-scale crisis in the US will inevitably trigger a systemic shock for the entire global economy, and the consequences will be heavier than last time. The question is how America will weather this storm and whether Trump can offer a real solution. For now, his administration projects confidence, but more and more analysts write that this confidence is merely a facade hiding a growing crisis. And if inflation does take hold in the coming months, the US will face pressure it has not experienced in decades.